Gallery, bring the body in. Today's patient is not a fictional shell company operating from a mailbox and 3 press releases. Innoviz has real LiDAR hardware, real engineers, real automotive programs, and a habit of calling shareholders whenever the blood bank runs low. On July 28, 2026, only 8 days before second quarter earnings, Innoviz announced a registered direct offering representing up to 66.67 million new shares or share equivalents at 45 cents each. Roughly $30 million in fresh blood, priced almost 30% below the previous close. The stock collapsed toward the deal price, and investors were left asking the obvious question: was this responsible runway management, destructive timing, or both? Tonight we open the case file on Innoviz Technologies. Ticker INVZ. Diagnosis pending. Welcome to Wick's Market Mortuary. I am Inspector Wick, Chief Market Coroner. I do not chase stocks. I examine them. The market is not just a collection of tickers. It is a crime scene. Tonight's examination contains German automobiles, autonomous trucks, 3 Nasdaq compliance episodes, and enough new equity to require additional refrigeration. This examination is for informational and entertainment purposes only. It is not financial advice. Do your own investigation before entering the crime scene. Now, let us begin. Innoviz develops automotive-grade LiDAR sensors and perception technology. LiDAR uses laser pulses to create a 3-dimensional picture of the surrounding environment, giving vehicles depth perception without asking the driver to stop checking messages at the red light. Its products include Innoviz 1, Innoviz 2, Innoviz 3, Innoviz Smart, and newer defense applications under the Persis brand. The company is also working as a direct Tier 1 supplier, responsible for manufacturing, integration, quality, and years of customer testing before meaningful production revenue appears. This is the central medical problem. The organs are real, the treatment is expensive, and mass production keeps its own appointment calendar. Innoviz is not being examined as a fake business. The developing diagnosis is a legitimate company suffering from chronic cash burn anemia and repeated shareholder-funded transfusions. Innoviz entered the public market through a SPAC combination in 2021 with ambitious projections and a generous valuation. The share price did not preserve well. The company continued spending heavily through long automotive development cycles, but a development agreement is not production revenue. A nomination is not a purchase order, and a future launch does not pay this quarter's payroll. While Innoviz waited for high-volume programs to arrive, it repeatedly sold equity. An August 2023 financing generated approximately $61.4 million net. A February 2025 registered direct generated approximately $37.3 million net. A TM sales supplied more capital before July 2026. Brought another $30 million transfusion. The company was not funding the future with internally generated cash. It was purchasing more time using pieces of itself. Innoviz's minimum bid problem has now returned 3 times since 2024. The first notice arrived in July 2024, followed by restored compliance that December. A second deficiency arrived in March 2025, with compliance restored again in July. In March 2026, the condition returned for a third examination. The current initial deadline is September 21, 2026. The notice does not mean immediate delisting, and Innoviz still has time to regain compliance. But at approximately 45 cents, the stock must more than double merely to reach $1 and then remain there for the required closing bid period. That makes reverse split risk real, but one correction matters. Shareholders previously authorized a reverse split between 1 for 4 and 1 for 10. That authorization expired in July 2025. No currently effective replacement authorization has been identified. Management may eventually request another reverse split, but the old surgical consent form appears to have expired. Risk present, procedure not yet scheduled. Before the financing, INVZ had already spent months in a deteriorating range around the 60-cent area. Some investors called the action bar coding. That may describe the chart. It does not prove leaked information, deliberate suppression, or manipulation. Then Innoviz announced the 45-cent deal. The previous close was around 64 cents. The offering therefore reset the reference price nearly 30% lower. The shares quickly fell toward 45 cents. That reaction was not mysterious. When management sells a massive new block of equity at a deep discount, the market often reprices existing shares toward the price accepted by the new buyers. The chart did not discover support. Management printed it. The announced transaction represents up to 66,666,667 ordinary shares or share equivalents at 45 cents each. Gross proceeds are approximately $30 million before fees and expenses. Titan Partners. Securities is the sole placement agent. Westpark Capital is the financial advisor. Executives and directors accepted 45-day lockups. The company accepted a 45-day restriction on certain additional equity issuances, subject to exceptions. Proceeds are for general purposes, including purses commercialization. This was not structured like the February 2025 financing, which included conventional warrants with a meaningful exercise price. No new traditional common warrants were announced here. However, investors may receive pre-funded warrants instead of ordinary shares. Those instruments carry only a nominal remaining exercise price and may be used to stay below ownership limits or at the purchaser's election. So no conventional common warrants were announced, but pre-funded warrants may substitute for some shares. Economically, that dilution has already entered the waiting room. The correct outstanding share baseline is not the weighted average count used for earnings per share. As of March 31, 2026, Innoviz reported approximately 221.4 million ordinary shares outstanding. Against that baseline, 66.67 million new share equivalents represent an increase of approximately 30.1%. The provisional post-offering count becomes roughly 288 million. New investors would own approximately 23.1% of the resulting company. Existing shareholders would collectively retain about 76.9%. A shareholder owning 1% before the deal would hold roughly 0.77% afterward, absent participation or other issuance. The company receives cash. The old shareholder receives a smaller slice. The pie became larger. Nobody asked whether the original guests were still hungry. The final number may shift with later ATM or employee issuance, but the scale is clear. This was not a small injection. It was approximately a 30% share equivalent dose. The July raise was only the latest entry in the blood donation ledger. During Q1 2026, Innoviz sold approximately 6.16 million ATM shares for about $4.2 million net. The February 2025 deal also left approximately 23 million warrants exercisable at $1.69 through February 2030. Older $11.50 SPAC warrants were scheduled to expire in April 2026, and absent an extension, should no longer count as live dilution. The new 45-cent offering does not appear to automatically reprice the February 2025 warrants. Their terms provide conventional adjustments for events such as stock splits and major transactions, not an obvious full ratchet reset for cheaper equity sales. The room is crowded enough. There is no need to invent additional bodies. Now we open the first quarter laboratory results. Revenue was approximately $7.1 million. 1 year earlier, it was approximately $17.4 million. Gross margin fell to approximately negative 22%. Operating expenses were approximately $24.9 million. Net loss was approximately $26.2 million. Operating cash used was approximately $14.45 million. Revenue composition explains much of the damage. Sensor revenue increased from approximately $1.5 million to $3.9 million. But engineering and non-recurring development revenue fell from approximately $15.9 million to $2.9 million. Management said certain milestones moved beyond the quarter partly because customers requested additional work. That may be reasonable, but it also reveals how unstable the revenue base remains. A milestone payment can make one quarter look healthy. Its absence can make the next quarter request last rites. Revenue arrived on a stretcher carrying $7.1 million. Operating expenses were already waiting with a $24.9 million invoice. The offering presentation supplied preliminary second quarter information before the full earnings release. Management estimated Q2 revenue between approximately $17.9 million and $18.1 million. That suggests a sharp recovery from Q1. Management also estimated June 30th liquidity between approximately $48.4 million and $48.5 million. At March 31st, liquidity had been approximately $60.1 million. That is an apparent decline of roughly $11.6 million. But that decline is not automatically equal to operating cash burn. Reported liquidity includes cash, deposits, marketable securities, and short-term restricted cash, so working capital and other movements can affect the total. The preliminary figures were prepared by management and were not audited or reviewed by the independent accountant. The responsible conclusion is simple. Revenue appears to have recovered. Liquidity appears to have continued declining. The body sat up. The blood bag was still draining. This is the center of the case. At June 30th, Innoviz still reported preliminary liquidity near $48.5 million. Why sell approximately 30% more share-equivalent securities at 45 cents only 8 days before earnings? Several explanations are plausible. Automotive customers conduct financial diligence and do not want a critical supplier running out of cash halfway through a vehicle program. A stronger balance sheet may improve confidence. Upcoming launches and purses may require tooling, inventory, engineering, and working capital. Management may have preferred guaranteed capital, while institutional investors may have demanded a deep discount. But plausible explanations are not proven facts. There is no verified evidence of an earnings warning, deliberate suppression, or a financing designed to force a reverse split. The documented fact is enough. Management accepted 45 cents, 8 days before shareholders were scheduled to receive the full Q2 examination. Innoviz's revenue is not yet dominated by stable, high-volume automotive production. It includes sensors, engineering work, non-recurring milestones, and related services, and those sources do not deserve identical valuation. A milestone is useful but not recurring production revenue. A nomination matters, but is not a guaranteed order. The long-term thesis depends on production sensor shipments becoming large enough and profitable enough to replace volatile development payments. The programs are real, but remain subject to execution. BMW and Magna show production capability, though volumes depend on purchase orders. Volkswagen and Cariad include conditions and termination protections. Mobileye was described as a term sheet, not automatically a final supply agreement. Daimler Truck and Torque carry more weight through a disclosed long-term agreement for autonomous Cascadia trucks. Innoviz currently targets major program starts of production in 2027 and 2028. Those dates are management expectations. They are not appointments guaranteed by the coroner. Persis is Innoviz's new defense and homeland security brand. Potential uses include counter-drone systems, perimeter protection, and critical infrastructure security. Innoviz has named engagements or deployment opportunities involving Kayla, Drive Group, Given, Regulus, and Aeronews. LiDAR has legitimate defensive applications, but the disclosed economics remain thin. We do not yet have enough public information on firm orders, backlog, contract value, units, recognized revenue, gross margin, or the exact amount of financing allocated to Persis. An opportunity to deploy is not automatically a production contract. A pilot is not a battalion. A press release wearing camouflage is still a press release. Persis may become an important new organ. At present, it remains under observation. The annual filing does not portray Innoviz as an accounting corpse. Management concluded its controls were effective at year-end 2025. No material weakness or going concern qualification was located in the reviewed filing. The documented problem is cash consumption and execution, not accounting collapse. The SPAC-related lawsuit also requires accurate treatment. A court dismissed the case with prejudice in November 2025, but the plaintiff appealed. The trial court declared it dead. The appellate court has not signed the certificate. The same caution applies to squeeze claims. Dilution does not automatically create one. That diagnosis requires current short interest, float percentage, days to cover, borrow availability, and post-offering share data. High volume and a low price are not proof of a squeeze or illegal short selling. The central market mechanic here is much simpler. The company added cash. Existing holders absorbed dilution. The effective tradable supply may increase. All three can be true at the same time. The bull case begins with real automotive-grade technology, production experience, and programs involving major automotive and autonomous driving companies. Sensor revenue improved in Q1, preliminary Q2 revenue suggests recovery, and the financing extends runway. Perceives could diversify the business. If high-volume programs begin in 2027 and 2028, the economics may improve dramatically. The bull case is not absurd. It is scheduled for a future appointment. The bear case begins with a long-term price collapse, 3 Nasdaq deficiency cycles, large operating losses, negative Q1 gross margin, volatile milestone revenue, ATM sales, approximately 30% new share equivalent dilution, reverse split risk, and programs that can still be delayed or disappoint on volume. The bear case needs no fraud. A legitimate company can still be a destructive investment. The morgue receives plenty of authentic businesses. After examining the filings, financing history, program agreements, Nasdaq record, and preliminary Q2 results, the diagnosis is legitimate operating company, chronic cash burn, anemia, recurring shareholder transfusions, approximately 30% new share equivalent dose, Nasdaq condition, third recurrence since 2024, reverse split risk present but no current authorization identified, Perceives, promising new tissue, commercial economics pending, disposition under observation, not pronounced dead, not accused of fraud, definitely return to the examination room. Innoviz may survive the gap between development and production. The capital may reassure customers and extend runway. Existing shareholders paid through another major reduction in ownership. The treatment may help the patient. The invoice went to the gallery. Gallery. INVZ is the story of a real company trapped in an expensive race against time. Automotive programs move slowly, payroll does not. And the equity market remains open for companies willing to sell another piece of themselves. Whether this transfusion proves worthwhile depends on Q2 cash flow, progress toward production, Perseus economics, and the Nasdaq compliance plan. Until then, the case remains open. This examination is for informational and entertainment purposes only. It is not financial advice. Do your own investigation before entering the crime scene. I am Inspector Wick, Chief Market Coroner. The chart may move. The filings do not blink. Like, subscribe, stay alive. And I will see you tomorrow, unless you beat me here.